My name is Blake Noblock, and I'm presenting on the yield curve. Sorry if the quality is difficult. I don't have a way to do this on my computer, so I'm doing it on my phone. But the yield curve is found in our textbook. I just looked it up in the index to find the pages that it's on. I don't have the exact pages, but if you do have any questions, you can reference that. Or feel free to send me a message. So the yield curve is used to compare interest rates against other debt securities. Um, these rates change daily, so investors often will use this to compare the time value of money. Typically, the longer the investment, the higher the interest rate. Investors will look at the curve to try to find the highest rates for the shortest amount of time. So, they use these a lot. Primarily, they're mostly used with U.S. securities and Treasury notes. The maturity premium is an important term, so this is defined by the book as the difference between the required yield on long versus short-term securities of the same characteristics except maturity. So assuming everything's the same, basically what the maturity premium is, you earn a premium for having a security for a longer period of time. So the longer you have it, the higher the interest rate, and that difference is the premium. And yield curves have three shapes, and we're going to look at those. So the first one, and this is the most common, is the positive yield curve, which this makes the most sense. It's the upward sloping curve, and as you can see, the maturity premium is positive here. So the more years you go, the higher up the interest rate is. This is the opposite. So this is a negative yield curve or an inverted yield curve, and this one obviously is downward sloping, and the important thing here is they don't typically last very long. So one example of this would be one point in time the United States began to pay off their 30-year debts, and that lowered the rate of those securities knowing that they'd be paid off soon. This next one is the flat yield curve. This yield curve, as you can see, pretty much just stays the same, and the yield is the same regardless of how many years it is. Then the last thing here is there's three different theories to try to kind of explain these curves. The first one is the unbiased expectations theory, and then we'll look at the liquidity premium theory, and finally the market segmentation theory. The unbiased expectations theory is defined in the book as at any given point in time, the yield curve reflects the market's current expectations of future short-term rates. So basically, what that means is, let's just say that it's expected that the 1-year bond is going to increase in rates. What you could do is you could buy 4 1-year bonds to take advantage of the increase instead of 1 4-year bond. If you buy a 4-year bond and then the rates go up, you might not be able to make as much money. So this is something where they can buy 4 1-year bonds if they're expecting the rates to go up. So that is a little bit of what drives the rate. The next one is the liquidity premium theory. This one is just like it sounds. The theory states that investors will only hold longer-term securities if there is a premium to offset the future uncertainty of the security's value, which this makes sense. This is pretty much risk-reward, very consistent with that. A longer term brings out more risk, and that requires, you need a higher return for that risk. So because of that, investors prefer short-term securities because they're more heavily traded and they can be easily converted to cash if risk does pop up. So that's why, the short-term securities have a lower rate because there's a lot less risk because they can convert that to cash easier. And that's why you see our curve, it slopes upward. It's not a linear line. It slopes upward towards the end because that investor will earn a higher rate as time goes on. And then the last one is the market segmentation theory. So individual investors have specific maturity preferences, and convincing them to hold securities with maturities other than their most preferred option requires a higher interest rate, or as we discussed earlier, maturity premium. This one's a little bit interesting. It's different. This is the only theory that specifically takes demand into account and states that the higher the demand, the higher the yield. One example is, if a lot of insurance companies need 10-year notes because they typically have long-term liabilities, then the yield could be higher with the increased demand. So that's a common one. I like to think of, if you think of like people who put money away for a certain period of time, they already have a preconceived thought of how long they want to put their money away, and they're not really looking for the best value. They're looking for what they can get for that time. So it's almost kind of like CD rates as well. And so this theory states that that is what drives the market. If you guys have any other questions, I mean, feel free to message me and ask me, or you can find it on the book or ask our instructor as well. Thanks.